Hey guys, so today I'm talking about investment fees. And the reason for that is because there are still people out there that are falling for these, I don't want to call them scams, but there are insurance companies, investment companies that, they send salesmen out, and these salesmen for these companies absolutely do not have your best interest at heart, even though they're selling it like they do. But to their credit, they may not know any different. They may work for the company because a lot of these companies are just multi-level marketing companies. Some of them that will sell you insurance, they'll sell you whole life, they'll sell you annuities, they'll sell you mutual funds. All these products that they offer you, they profit off of. And you pay exorbitant amount of fees for these products they sell you year after year after year. And that's how the person that sold it to you makes their money. So are they intentionally ripping you off? Probably not. Okay, that's the good news. The bad news is the products that they put you in will most likely underperform and cost you a lot of money over time. And it doesn't seem like that in the beginning. So these are the investment fees to ask about before you invest with anybody. And the first one is expense ratio or internal expenses. It costs money to put together a mutual fund. So any fund, it costs money. So a fund with an expense ratio of 0.9% means that for every $1,000 invested, approximately $9 per year will go toward operating expenses. A fund with an expense ratio of 1.6% means that for every 1,000 you get $16 per year. Now that doesn't sound like a lot in the beginning, but just hold on. So number two, on top of that expense ratio, you have investment management fees or investment advisory fees. These are the fees that you are paying for that person to come to your house and talk you into the products that they have. So an investment advisor who charges 1% means that for every $100,000 invested, you will pay $1,000 per year in advisory fees. That's each and every year. And usually it's done every quarter. Many advisors or brokerage firms charge fees much higher than 1% a year. In some cases, they are also using high fee mutual funds, in which case you could be paying total fees of 2% or more. I've seen them as high as almost 3%. And that's on top of some other fees that you pay, like account maintenance fees. There's some fees in there, or trading fees, or we'll go into that. Here you go, transaction fees. So many accounts charge a transaction fee each time an order to buy or sell a mutual fund or stock is placed. These fees can range from $9.95 to over $50 per trade. So a $50 transaction fee on a $5,000 investment is 1%. So, this is real money coming out of you, and it adds up. Now, a lot of times these professional marketers from these companies will put you into mutual funds that have front-end loads. And what a front-end load is, basically you paying the privilege to have access to the fund. It's basically what it is. So if you were to buy a fund that has a front-end load of 5%, and I've seen them, it works like this. You buy shares at $10 per share, but the very next day your shares are only worth $9.50 because 50 cents per share was charged as a front end load. Or they can do it differently. They can sell you the shares at $10, but they'll say it's $10.50. So, and then you end up with $10 a share. Either way, you're paying. And then they get you going. Back end load or surrender charge. So in addition to the ongoing operating expenses, in addition to the investment advisory fees or management fees, in addition to the transaction fees, you can get a back end load or surrender charge. So the fund may charge you a 5% back end load if you sell it in year 1, a 4% fee if sold in year 2, a 3% fee if sold in year 3, and so on. So a lot of these can, there's a lot of detail, a lot of fine print in a lot of these. And here we go, the account fee, annual account fee or custodian fee. So for the privilege of having your account with them, they'll charge you $25 to $90 per year, basically to, I don't know, be honest with you, send you a statement, a yearly statement or a quarterly statement. I mean, that's kind of the way things go with some of these companies that do this. And just to show you the effect, here's a table, the effect of management fees on your IRA balance. This assumes $2,000 a year contributed, 10% annual return before management fee. So if your IRA balance after 40 years and your management fee is 0.02%, you'd have $968,249 after 40 years investing $2,000 a year. But you start getting a 1% management fee, and that suddenly drops from $968,000 to $736,000. And I've seen some with a 3% fee ongoing. This is ongoing for as long as you're with this company. So instead of $968,249 with a 3% management fee, you only end up with $427,219. So over 50% less you've paid in fees. So the company that came to you to sell you these and thinking and got you convinced that they had your best interest in mind, just made over $500,000 off of you. $500,000 off of you, out of your pocket, that you could have had. Now, you got to say, now, what is the alternative? Well, the alternative is just to do it yourself. I'm a big fan of Fidelity. If you're going to do mutual funds, I like Fidelity. They have some actively managed accounts. Vanguard does too, but I have an account with Fidelity, so I'm more familiar with it, and that's why I'm talking about it. And you can basically buy your own actively managed mutual fund. I normally don't suggest actively managed, but if that gives you some peace of mind that there's somebody managing that portfolio, that fund, your money, then I don't see a problem with it, because Fidelity has one called the Balanced Fund, FBALX, and you'll see the minimum to invest is 0. Your expense ratio is 0.53. So you're going to be in the middle of the road here. So after 40 years, if you invested $2,000 a year, assuming 10% annual return, this would have costed you about $120,000. That's a heck of a lot better than 500,000. But if you wanted, and this is just a basic 70, let's see, 64, 68, about a 70% stock, 30% bond portfolio, which, is kind of standard fare. Pretty much what these big wigs are going to put you in that are going to charge you a bunch of fees. So, but if you wanted, you can cut these fees down even further by just doing a little bit more work. And if you go into the mutual funds with Fidelity and you click on the Fidelity funds only, no transaction fee only, and then you sort it by expense ratio, you can come up with some 0% expense ratios. That's correct. There is whatever you put in this and whatever this fund returns, you keep 100%. So they have a total market index fund, which would be good for your stock portfolio. And then they have US bond index fund that would be just fine for your bond exposure. So you just have to, if you have $10,000 to invest and you wanted to do a 60% stocks, 40% bonds, you just put $6,000 in your total market index fund and you put $4,000 into your intermediate or U.S. bond index fund, and that charges a 0.025% expense ratio, which is nothing for bonds, because bonds usually have a little bit higher expense ratios for the most part. So right there, you have 0% expense, and there's no transaction fees in these. There's no minimum to invest, and you just invest while you invest what you want. There's no price on the shares, so there's no minimums. Like, for instance, it's not $50 a share. It's, if you wanted to put $20 in it, you can put $20 in it. It's that simple. I would suggest putting it in a Roth IRA if you're going to do these mutual funds, but that's a topic for a different story. But basically, you have your stock fund at 0%, and then you have your bond fund at 0.025. And it's super simple to do. You do not need these money managers to tell you how to invest your money, because I don't know what the percentage is. I should have looked that up before I did this, but it's something like 90% of mutual funds do not outperform the standard stock market. They just don't. And for the most part, it's because of fees. So that was a 0.025% expense ratio. So right there, if your management fee is 0.02, if you invested $2,000 a year and you got 10% a year, you probably won't with that bond exposure. But this is what you get. $968,249 instead of paying that big expense fees, transaction fees, commission fees, ongoing high expense fees, statement fees. I mean, they nickel and dime you. So I know this was a long video. Be careful out there. I don't know what to say. Just I wish there was better education out there for people to take control of their finances, because it's not that hard. It really isn't. And some of these companies that go out there and still get people to sign up for these high expense funds, it's horrible. It's horrible in my opinion, and I wish somehow they can be stopped. I don't know how. We just need to just keep talking about it, I guess. So anyhow, that's all I got for you today. If you have any questions, comments, leave them down below. If you know anybody that has invested with some of these companies that that charge high fees and they need to see this video, send them this video, and they can comment on the video or contact me. My email's in my About Us page. I'll help you. It's not hard. It doesn't take but 20 minutes to open an account and take control of your finances. So with that said, thank you, and we'll talk to you later. Bye bye.